We specialise in helping companies looking to improve their cash flow, whatever their circumstances. So as you can imagine, we're quite busy in this current environment. What I'm going to do today is, there is good news. I'm going to talk to you about some alternative funding solutions to the traditional bank facilities that are available. Cash flow is vital for the success of any business. Companies fail not because they're not profitable, but because they run out of cash. And the funding gap, the difference between when customers pay and suppliers get paid, can place a lot of pressure on cash flow. Now, traditionally, business owners go to their bank when they're looking for finance, and the overdraft is a traditional way of funding a business. Obviously, cash flow finance is vital for companies, and what we're going to talk about today is some of the alternative forms of working capital finance for companies. The products we're going to cover are invoice discounting, flexible invoice finance. The next product is asset-based lending, supplier payment finance and confirmed order finance. So invoice discounting very simply maximises cash flow by providing up to 90% of cash from unpaid invoices from trade debtors as invoices are raised. So rather than having to wait maybe 30, 60 or 90 days to get paid, you get the majority of the money the day you raise the invoice and then the balance as soon as the customer pays in full. The criteria for discounting, very broadly, you have to have a turnover in excess of €500,000, strong financials, so that's positive net worth, profitable track record preferably, good spread of debtors, no debtor ideally representing more than 25 or 30% of the debtor ledger, good management systems, that typically refers to computer systems, for example Sage or TAS books. Obviously you need good credit control systems, etc., and you need good management information, so more and more people are looking to their accountants to provide monthly or quarterly management accounts to support invoice discounting, and then typically it suits manufacturers, wholesalers, distributors and service companies. Just a very brief example of how invoice discounting can help a company. This is a client who was introduced to us a few months ago by their bank manager of all people. The company was turning over 6 million. They had an invoice discounting facility of 300,000 on a debtor's ledger of $1 million, and they were getting a 65% prepayment. They had a 50k overdraft and they had to pay their supplier in 7 days. The bank manager was looking at the bigger picture, was very keen to retain the relationship, and obviously 65% of the 300k funding line there was a lot of trapped availability in the debtor's ledger. So what we did is we arranged an invoice discounting facility which released 80% against the debtor's ledger funding line of 2.5 million. That gave the guy the finance he obviously needed for growth. It secured his working capital going forward, and it meant he was able to avail of supplier discounts. His projected turnover for the next 12 months is in excess of 20 million, so just to give you an idea of what that additional cash flow can do for companies in terms of expansion, etc. Flexible invoice finance, the funders take a more commercial approach to the lending, so rather than focusing on historical financials, balance sheet criteria, etc., their main focus is the debtor's ledger. They look at the receivable and basically look to see, is this fundamentally collectible, is it fundamentally discountable? If it is, they then look at the management and the future potential of the business rather than any past performance. To qualify for that facility, turnover needs to be in excess of €500,000 or heading that way. And as I said, there are no balance sheet criteria, so it's suitable for companies that might be maybe start-up, loss-making. So the benefits of invoice finance, obviously it's an immediate cash injection to a business. Generally speaking, the customers are unaware of third-party involvement. It improves supplier relationships. It allows companies to maybe either pay their suppliers earlier and negotiate supplier discounts. It can facilitate expansion for companies. It can strategically help fund acquisitions, MBOs, etc. And unlike the bank overdraft, it actually grows in line with sales. So as your turnover grows, so too does the amount of finance available. So invoice discounting is great for releasing cash out of the debtor's ledger, but sometimes companies need additional headroom to access more cash. And this product here, asset-based lending, it's a fantastic product for doing that. It basically releases cash through other assets as well as the debtor's ledger. So it's basically releasing cash against stock, plant and equipment, property, and also cash flow loans. The criteria here, features and benefits, it's suitable for companies turning over in excess of $1 million. Obviously financially sound, etc. It gives greater financial headroom than the invoice discounting. All the tangible assets are considered. Anything over the debtors plus stock, plant and equipment or property is typically over a 7-year loan, and the cash flow lend is typically over 12 months, assuming a decent repayment capacity through the cash flow. As I said, it places a higher value on those individual assets than a bank manager would. It's a great way of refinancing existing working capital and suitable for MBOs, acquisitions, etc. So invoice discounting, it meets a lot of requirements, but it doesn't suit all companies. For example, construction business, anything that is anyway contractual is generally unsuitable for invoice discounting. Luckily, there are other solutions available, such as this supplier payment facility. What it basically is, it's a line of finance which is used to pay suppliers and is secured against a company's balance sheet. This product was widely available through the banks up to about 3 or 4 months ago, and overnight they pulled the product. It was a fantastic product because basically it was secured on a credit insurance limit on a company. So if you had a company with a net worth of £1 million, you could just get a £500,000 funding line and go out and pay your suppliers and make lots of money. The features of this, it's based on the credit rating of the business. You need a strong positive net worth, you need to show profitable track record, etc. It doesn't have any impact on the bank facility. The exit is usually an insured bill of exchange, and there's no security required, because if you don't pay in 30, 60, 90, 120 days, they basically just go into their insurance company and claim against the insurance. Key benefit, obviously improve supplier relationships, maximise the business opportunities, and you can again avail of supplier settlement discounts, etc. Then our next product, confirmed order finance. If you imagine you're a new business and you win an order from a blue chip customer to supply goods, you're importing from China, and the Chinaman wants his money up front before he parts with the goods. Obviously, invoice discounting and supplier payment facilities aren't appropriate because you're paying up front for the goods. Typically, in that situation, a company will go along to the bank, and the bank manager is either looking for a cash deposit or bricks and mortar security or a very strong balance sheet. So this product is an ideal alternative for companies that mightn't have either the collateral to secure that sort of a loan, or the cash deposit, or the bricks and mortar security, etc. And what this basically does is it basically provides a line of finance to pay suppliers up front for goods that are pre-sold to quality debtors. The key features and benefits is 100% supplier payment. That can either be a letter of credit facility, or it can be a supplier payment facility where a financial institution gives an undertaking to pay a supplier at a certain point in time. They'll pay the duty and VAT. As I said, it has to be finished goods, and your margin needs to be in excess of about 20%, just to give the lender sufficient headroom. Great for startups, for young companies that may be perceived as the weak middleman who doesn't have, they may have all the contacts, they may have the ability to get the orders, but they don't have the finance to actually fund them. It takes out the need for equity finance, for giving away a percentage to your business for cash, etc. It's great top-up finance, and it provides purchasing power. It gives companies the confidence to go out and talk to the big boys and say, look, if we win this order for £1 million, we can fund it. We have the line of finance. The scenarios where any of those products might apply to your business, obviously the obvious one is cash flow tight. If you're growing rapidly, it may be that you're turning away business. If you're restricted by your bank facility, if you've gone along, if you're constantly hitting your overdraft, or if you've got a high overdraft limit, it could be that invoice discounting is a much cheaper option, a much more cost-effective option for you. The need alternative source of finance, a lot of business owners now are coming along and saying, we're not feeling confident about the bank. We want to secure other lines of finance going forward, and we need to know that they're secure. They're not going to be pulled from us overnight. If you're looking to fund MBOs, acquisitions, etc., the market is great at the moment for acquisitions. There's a lot of bargains out there, allegedly. So if you've got a high value debtors ledger, or just even if you simply want to maximise cash flow, these are some of the alternative forms to the traditional form of lending that's available. That's it, folks. Thanks very much for your time.